Looking at the big picture, we see across the globe, inflation is at 8.9%. Looking at just the Sub-Saharan Africa, which is a very developing nation's sector, we see that it has been peaking in inflation due to mostly food and other tradable goods that are imported. Now, the way that they have been dealing with this high inflation is they are raising their interest rates, just like how the US Federal Reserve is doing in their own country. But where we're at 4%, 3 to 4% on our federal funds rate, they're sitting at almost 15 to 20%. Now, this trend of higher federal funds rate is likely to continue across the globe. And while majority of the capital in the nation, in the world, is in our developed nations like the US, as we start to see all these developing nations tighten in their own countries, that tightening will lead and sink into our own capital markets as well. And with less money available in the lending markets, now it becomes harder for you to get your mortgages. It becomes harder for you to trade on margins. It becomes harder for loans for your car, new cars, for credit card loans, consumer loans, private loans, business loans. And so a lot of capital that has been very commonplace over the last 10 years with our 0% interest rate will all of a sudden be very expensive. Worst case, 20%. And it's going to be interesting to see how markets are going to be able to manage this much more expensive interest rate, especially considering we're going to be seeing some major demographic changes in the next 10 years that could really use some proper investments to reposition their assets. Curious on what your thoughts are. Let me know.